Screen share?
Absolutely. Mhm.
All right, let me pull up some slides here, which will hopefully help you get a better understanding of at least the equity portion of the SSBCI 2.0 program. So let me get this up and going. And can you see that okay?
Mhm.
I'm going to reduce your screen so I can see my screen better. And then get into slideshow. Let's see. Here we go. And then one last thing I need to do here. Let's see. Are you seeing a single slide or are you seeing like a dual slide?
Dual slides. I can see the ones on the side too.
Okay. So let's see. The Zoom bar is in the way. Here we go. Here we go. Okay, got it. Yeah, the Zoom bar always gets in the way for the menu icon you want to click. So anyways, hopefully you can see that okay. And Neil and Maddie, thanks for inviting Drew and I to join the Friday Forum, tell you more about what's happening with the SSBCI. So I'll tell you what's happening on the equity front and start by just giving you an overview of the program. Drew will cover more of the credit loan programs. I'll talk about the two equity VC funds, talk about our relationship and how we fit in working with Minnesota Deed. Talk about the goals. We'll focus on the direct investment VC fund, since I believe most of the people on the line are entrepreneurs, correct? And I think I recognize a few names out there. But I do want to tell you a little bit about the multi-fund VC, let you know what's happening there, because that's where we've been spending most of our time. And then talk about the direct investment VC process, and then I'll give you a status update in terms of where we're at and making investments and commitments we've made. So to start out with, this is part of a Treasury SSBCI 2.0 program, and all the states pretty much participated and were awarded some amount. Minnesota, I would say, was in the middle of the pack. You had some smaller, some greater, like California, New York. Minnesota was awarded 97 million all in, which is going to come in 3 tranches. So we're working on the the first tranche today, and think of the second and third tranche coming in at about 2 to 3 year increments. So once again, Drew will talk more about the various loan programs. Can you see my cursor as well? So, yep. Okay, anyways, and I'll talk about the 2 equity programs. Of the 97 million, 34.5 is allocated towards a multi-fund VC. I'm sorry, 34.5, excuse me, is directed towards the 2 VC funds. 22.4 of that is directed to a multi-fund VC fund, a fund of funds, where we'll make investments in Minnesota-based VCs or firms that are going to have a presence here in Minnesota. 12.1 of that 34.5 will go to a direct investment VC fund, where we'll make co-investments directly in Minnesota-based startups. And one of the overall goals of the SSBCI funds is to be able to catalyze private capital. So in the fund of funds, just like any other LP investor, we would close on a financing, on a fund close with other LP investors. So we would do that anyways. On the direct investment VC fund, we would syndicate a financing. So we wouldn't just invest on our own. We would look to co-invest with others. And as part of our strategy, and I'll talk about that, we want to make sure a financing is fully financed anyways, and that we've got knowledgeable investors around the table. As far as duties go, the University of Minnesota's Office of Investments and Banking, OIB, is an independent investment management service to make investments from these 2 funds. So we're completely independent of, say, Discovery Capital, Launch Minnesota recipients. We have no bias towards any of the companies that may be associated with the U or with Minnesota Deed. And it is a statewide program. We'll talk more about that more on another slide, but it is statewide. So we're also not, just looking at deals here within the metro area. Minnesota Deed will continue to manage the overall SSBCI program. So that includes compliance reviews, any final approvals on investment recommendations and approvals that have happened within OIB, and then for ongoing compliance reporting, and we'll take the lead on applying for the subsequent tranches. So overall goals, obviously we want to invest these dollars in Minnesota and build strong companies here. We want to, as I mentioned before, we want to be able to catalyze private capital. So, we're happy to tap our investor network as well to be able to, get other VCs to invest in Minnesota, and also, help catalyze deals with, LP investors, for example, when we're trying to get to a fund close with fund managers, and then once again, tap our network of investors to help pull financing together. Another big goal is to increase diversity within our business community and to elevate support within the socially and economically disadvantaged. So the SETI definition, just so you're aware, has a pretty broad definition. I think Black, Indigenous, people of color, women, that's, everyone I think understands that category of the underserved community. It also includes LGBTQ. It also includes the rural community. It includes military vets and the disabled. So it's a pretty broad category. The other goal is to generate positive impact to society. And then we want to be able to increase, as Neela said, access to seed and early stage venture capital here in Minnesota, and also make this a sustainable source of VC dollars. So that has certain implications. That means we're going to be return driven in how we invest our dollars. And not because we report to LP investors who are looking for premium returns, it's because we want to create returns to be able to grow the funds and continue to reinvest those dollars within Minnesota. Let me stop there. Are there any questions? I'm happy to take some questions. Or Maddie, Neela, did you want me to go through this, or do you have any pause for questions as we're hitting certain maybe breakpoints in the slide here?
Sure. Why don't we stop for 30 seconds, see if there's any questions. If not, we are going to carve out plenty of time at the end for questions on all of this. And so feel free to drop them in the chat at any time or ask them now.
Okay, yeah, I thought this might be a good break point in terms of overall goals. So let's talk about the overall interest. So what we did was we took a look at, okay, where's innovation happening within Minnesota? Let's take a look at some of our entrepreneurial organizations, such as Medical Alley, Naturally Minnesota. Let's look at some of the accelerators like Beta, Generator, Techstar, and so on. And let's take a look at our competitive, our corporate landscape as well, and see how we could feed innovation within our corporate landscape. So what we came up with was ag tech, food tech. It's really a subset of climate solutions, but we pulled that out and wanted to highlight that. I know there's a lot of initiatives going on to be able to cultivate that industry. Life sciences, which we're obviously strong in. So, digital health, some med tech, solutions that are going to improve how providers practice medicine, how we can make healthcare more equitable, how we can increase access to care and have a positive impact on health economics. Climate solutions, advanced manufacturing, as you know, that represents close to half of our Minnesota economy, and then software and technology enabled businesses. Okay. As far as criteria, I don't think this will be any surprise. We're going to, look at the management team, the quality and experience. We realize we're going to be working with some first-time entrepreneurs as well. So really, just understanding, what their experience may have been in the past that may make them a good leader in a startup, and to be able to learn and how to be successful within the startup world. Obviously, Minnesota-based, seed and early stage financings, and that could have a broad meaning. So, pre-seed, seed, Series A, but we've also seen some Series B financings that really look like an early stage Series A. So regardless of the label, we're really focus on seed, early stage financing, regardless of what that label may be. We're looking for novel solutions that, once again, can generate a positive impact to society. And we're going to look for strong business fundamentals and that it's a sustainable business. And you'll see in our website, we have a similar list of criteria, and we purposely make that somewhat broad because we want to understand whether or not that entrepreneur has an understanding of what are those key business fundamentals. So I'm happy to go through that more, but we purposely keep that broad because we want to understand what the entrepreneur knows about that. As we talked about, another criteria is how a startup may increase diversity within our business community and also leverage strengths, resources within Minnesota. So are there certain suppliers, maybe service providers that would be a good resource for that company? And also, how does it feed into our corporate landscape? So we might continue to grow that business, build jobs within the state of Minnesota. And then once again, we want to make sure financing is fully financed. So the ability for that entrepreneur to be able to get a lead investor and also pull a syndicate of investors together to make sure that financing is fully capitalized. It gets the company to a logical set of milestones, valuation, inflection point, and that we could also be there to continue to support that company if they stumble or to help catalyze a subsequent financing. And then another area where I don't think entrepreneurs really spend a lot of time on is what does path to liquidity look like? What do the financing needs look like to get you to that point? Is path to liquidity, one liquidity event? Is it multiple points where you could potentially jump off, exit, and provide returns to investors? So really understanding, how that company grows, what are the financing needs, and how do you get to liquidity, and what do those returns look like? And then, once again, DEED is going to be responsible for SSBCI compliance, but we're going to help, facilitate that. And if there's some initial screening we can do to make sure the company is compliant with SSBCI guidelines, we're going to help Drew do that. So on the direct investment strategy side, I think the first thing to keep in mind is, the dollar amounts we're dealing with. So once again, we're working on the first tranche. Second and third tranche will come in about 2, maybe 3-year increments. So the first tranche we're working out of is 3.5 million. Second and third tranche will be about 4 million each. That includes netting out administrative costs for Minnesota DEED, and also assumes that we're going to hit our SETI incentives and our goals, which will also deliver SETI incentive dollars. And we're confident we can do that based on the fund managers that we've invested in to date, and I'll talk more about that, and some of the deals we're seeing. So within each tranche, given the fact that we're doing seed investing, we want to build a portfolio of about 12 companies, thinking that 2 or so may be successful. So if you do the math, the average investment size might be 300,000 with initial investment of 200,000 and the ability to follow on with 100,000. And that could vary a lot depending on the type of startup we're investing in, our conviction in that startup, and what the capital needs are. So for example, if we're, I'm looking at one deal right now where we're pretty excited about it, and we, might go to 500,000 as an initial investment. We're also looking at, for example, CPG food, where that initial investment could be somewhere around, 50 or 100,000, and it could be meaningful for that particular financing stage. The other thing to keep in mind is we do have the second and third tranche. So if there's certain portfolio companies within that first cohort that we're really excited about, we could follow on with that second and third financing. So, total capital all in could be much greater than that 300,000 average that that we've discussed here. And then the other criteria is, I'm sorry, the other, excuse me, the other part of our strategies, we want to, work closely with the VC and entrepreneur community to make sure we're getting quality deal flow. We've got access to SETI opportunities, and that we can leverage our domain expertise, and also work with VCs who have certain domain expertise in areas that we may not be as familiar with. And then once again, to be able to catalyze private capital, be able to pull in investors from our network to get involved in the Minnesota market and invest in this region. Maybe let me stop there and see if there's any questions. Nope. Okay. So I do want to talk about the multi-fund VC side, because this is where we've been spending most of our time. We wanted to prioritize investments with fund managers to be able to open up this channel of SSBCI dollars for the entrepreneurs. So in this particular case, we are working with the first tranche of about 6.5 million. The second and third tranche will be about 7.5 million. And our thought is we want to be able to cover all the capital call requirements within a given tranche. So we don't want to have to count on the second and third tranche to be able to make sure we can make our capital call commitments. We're thinking that we want to invest in about 6 VC fund managers, and we're close to that. Once again, I'll give you a status on that. So if you do the math, once again, our average investment size might be $1 million. But that could also range. In this case, we've made investments ranging from 500,000 to 1.5 million. Some other criteria is we just like any other LP investor, at max would be 10% of a given fund size. And then once we need to update our website so you know who those VC fund managers are that we've made investments in today. And I'll cover that on this call. Okay. So as far as the process goes, it's going to be similar to any VC. We're going to source deals. We do have an online application, and then we are actively reaching out as well. We're not just going to sit back and wait for applications and investment opportunities to come in. I will tell you that and we'll admit that the online process is a little quirky. So I'll give you my contact information in the end. And that's really the best way to get a deal in front of us, is just send it to me directly. And Maddie and Neela, you've got my contact information, obviously. So, I'm always happy to get a reference from you guys. So beyond deal sourcing, we'll take an initial screen just to see if it's an overall fit with our investment criteria. Does it fit in the areas of interest? Is it, the type of stage financing that we're looking at? And, does it fit, once again, with some of the goals of the SSBCI program? We'll then do an initial cut on due diligence just to get an overall understanding of investment merits and risk, see if there's any non-starters. If we continue to be excited about it, we'll move into active and deep due diligence, where we're really starting to dig in things like, problem solution statement. Why is your solution novel? What does the market opportunity look like? The management team, what does the financials look like, and path of liquidity, and so on. If it gets through diligence, I'll make an investment recommendation to the investment committee, and they can either approve or decline. And just to give you a flavor of who's on that investment committee, it includes the Chief Investment Officer, Stuart Mason, of the Office of Investments and Banking. It includes the Deputy Chief Investment Officer, Andrew Parks, Director of Operations, Stacy Hebden. And then we wanted to get a external VC investor as well, someone who's been a big part of the community, has invested in a lot of different sectors, and has really, I think, has a good presence in the community. So we also have Jeff Hink from Rally Ventures on the investment committee. If we get through the investment committee, then we'll do final due diligence, like legal due diligence, making sure it complies with SSBCI compliance and work with Drew to get her review on that. If that all passes and the SSBCI guidelines are, if that review passes, then Minnesota Deed will give us a final approval on the transaction. We'll make the investment recommendation, decisions, and approvals. The Minnesota Deed will just give a final approval based on SSBCI compliance. And then, post investment, we're happy to meet with the portfolio company as needed. Where we can be a value-add resource, we're happy to do so and lend our experience. And then we'll facilitate SSBCI reporting requirements and work with Drew to make sure she's getting the information she needs to do her SSBCI compliance reviews. So let me stop there before I give you kind of the status, what we've done to date. Any questions at this point?
Then it looks like there's a quick one in the chat. Could you elaborate on what would be some non-starters?
Yeah. So maybe some non-starters would be, for example, if you think about our areas of interest, a lot of it is, technology based, IP. Obviously, not every company would have IP or requires IP, but those would be some, things that as far as criteria goes, we would tend to look at those type of companies. So, for example, we've seen deals come in where it's a beauty salon, right? It's more of a family business. Or, for example, so that would be one extreme. Another extreme might be it's a really big capital intensive deal where going in, it's going to take like, 100 million to get that company to a commercial product, and probably additional dollars to be able to get market adoption. So that's a capital intensive deal where our investment bite size, really, it would be really difficult to be able to, get returns for that, within that type of a deal when we can't really follow on. If we could, make that initial seed investment, but follow in the subsequent rounds like A, B, and so on, then that makes sense. So we have to understand kind of the sector we're playing in and whether our investment bite size even allows us to play within that type of industry. I'll give you another example. So within climate solutions, we've looked at certain sectors where the capital needs are high. The time to exit is like 10 to 12 years. And then the valuation metric says at the end might be a 2x on revenue. So when you think about capital needs, investment time horizon, and in the end, the valuation metrics are not that great, it's just not going to give you good, VC type returns. It's not going to give you the type of VC multiples you would expect for taking the risk early on. And it's certainly not going to give you the type of VC IRRs that you would expect for taking that risk early on. And that's another example is, maybe certain fundamentals within the business model, like is it proprietary? Or another example might be it's a cluttered market. We get that. Or there might be, holes in the IP. That might be another example. But the other big one, once again, is we want to understand what does path to liquidity look like? And I will tell you, that's a place a lot of entrepreneurs do not fully understand and really how to do that analysis. But, I'm happy to help them with that if that's the case. But that's really another area, especially when we're looking at sectors like climate solutions, ag tech, food tech, and so on, that could be pretty capital intensive. Sorry, that was a long-winded answer, but does that give you?
You've got to follow on to something you said too, which is what kind of multiplier you're expecting, and if you're expecting the companies you invested to eventually be acquired.
Yeah, so I think as far as path to liquidity, yes, in a lot of cases we expect that the exit will most likely be most likely be a M&A type event. There might be some cases where it's a company that eventually might move on to a IPO. But if you think about some of the companies we're investing in, a lot of them might be first-time entrepreneurs. So really, M&A is the most likely path. But if it feeds within our corporate landscape, and that strategic acquirer could be in Minnesota, and once again, we can, help continue to build that company within Minnesota, create jobs, and so on. As far as return on capital, like any seed early stage deal, is going to depend on the risk. So as you know, expected returns is based on the risk you're willing to bear. So the greater the risk, the greater the return multiple you might expect. So let's say pre-seed and seed, then we would look at double-digit type return multiples. If it's a Series A, maybe it might be mid single-digit to low double-digit type return multiples. If it's a Series B, that still feels like an early stage deal, then it might be more of that mid single-digit return multiple. Does that give you a good flavor of what we're looking at? Once again, it just depends on the risk profile of the deal.
Sounds good, Finn. Thanks. There's one more in the chat, looks like. Do you consider any ESG factors for investing?
We do, but we're going to balance that with returns. So we still, once again, are going to be return driven. And ESG factors, once again, one of the things we're looking at are climate solutions and how you can make a positive impact to society. So yeah, that's going to be, that's going to definitely be a big factor. But like I said, we're going to look at this like a traditional investor and make sure that there's the opportunity to make returns and continue to grow these funds and make it a sustainable source of capital. But definitely that factors in. And by the way, a number of deals, if I could just mention, and I'm happy to share kind of the things we're looking at, are in the food tech climate solution space. Those are some of the ones that have risen to the top and probably is occupying most of our time as far as the direct investment goes. So yeah, definitely a factor. Sorry, long-winded answer.
No, that's great. Thanks. Okay. Anything else before we keep going?
Yeah, I'm sorry. Go ahead.
Oh no, that's
Any
all
other
I have.
Any other questions? Okay. All right, let me just give you the status update. So once again, we've been spending our time on the multi-fund VC side. We've made 4 LP investment commitments. 3 have gotten across the line, and there have been some releases. So if you haven't seen it, our first investment was in Brown Venture Group, and then Groove Capital, and then Tundra Ventures. And just so you're aware, in terms of where they're at, Brown Ventures has raised a total of about 38 to 40. I'm not exactly sure where they're at today, but it's going to be between 38 to 40 million. But keep in mind, they've been making investments along the way. So in terms of dry powder on the side, it's going to be something less than that. Tundra Ventures, my last calculation is they've closed on a total of 4.75 million. Once again, they have been making investments along the way. We have come in for both Brown Ventures and Tundra in subsequent closes. Groove Capital, we came in on a first close for their Fund 2. They've done a second close as well. And so they're at about 11.5 million in terms of capital raised today. And I think they're on their way to hit their target. So, I think, these 3 funds are off and running. And I know Brown and Groove at least have been really active in doing deals. And also going back to our ability to hit our SETI goals, I think with these fund managers, especially, that really, increases our probability, and, they'll be a great platform to be able to access SETI deals and put money to work in that underserved community. The 4th fund we've invested in, you could probably guess, but I'm going to hold off until we actually close on the deal, which should be next week. But it's two women general partners. They focus on healthcare, digital health solutions, and women-led companies. So we're going to get that across the line, hopefully within the next couple of weeks, and they'll be up and active as well. On their direct investment side, we've seen about 250 or so deals come in. I would say in terms of really starting to do at least preliminary diligence and get to understand them, about a dozen to 15 kind of rose to the top. And then that narrowed down to a group of about 5 to 6. And more recently, we've had 2 drop out, didn't make it through the diligence process. And I would say 2 of those have really risen to the top and where I'm spending most of my time. One's related to digital health, and the other is in the food tech climate solution space. And then the other 2 are in the back burner right now until we, get to a decision and some sort of closure on the 2 deals I just mentioned. So that's kind of what the pipeline looks like for the direct investment side. You can get a feel for the numbers and how it's narrowing down. And going back to the multi-fund VC side, so we're 2/3 of the way through in terms of the number of fund managers we would invest in and the amount of capital that we would invest in out of the multi-fund VC. So we're taking a bit of a step back and really focusing more of our attention on the direct investment VC side now. So that's kind of the update. Any questions on that? Okay. All right.
Cool. All right. Thank you so
I'll
much,
stop
Finn.
sharing at this point.
Okay.
I'm sorry. There's one last thing I wanted to mention. I'll share the slide with you, Neela and Maddie, and you can distribute accordingly. It'll have our contact information on the very last slide. And like I said, if you want to forward an investment opportunity our way, my email is really the best way to do it versus the application portal on the website. Okay.
Got it. And then one quick question. Are the investments going to each of your markets or to existing VCs?
I'm sorry, are each of them going to?
Mike asks, are the investments going to each of your markets or to existing VCs?
So on the multi-fund VC side, those investments are going to VC firms. On the direct investment VC side, those are direct investments in companies and startups. And those are the markets where, those are the markets of interest, right? But in terms of how much gets allocated to each one, it's just going to depend on deal flow. And there could be other, industry sectors that become interesting. So anyways, that's how the dollars will be allocated.
Got it. Thanks. All right. Well, we are going to keep things moving. Again, if you have questions, keep putting them in the chat, and I'm going to hand things over to Drew, who is going to touch on a few more SSBCI programs.
Thanks, Maddie. Yes, and I know Finn pitched that I was going to talk about all of the loan programs, but I'm actually going to focus on the growth loan fund because I think that's of the most interest to this audience. So just a little, let me, figure out how to share. All right, is that good? I can't see you guys now. Sorry, Zoom always throws me off. Just to touch a little bit and integrate with what Finn was saying, and so that this is not too much of a shock, given it's a lot of money in SSBCI, but still somewhat limited funding from program to program. So growth loan fund and direct investment program have fairly similar, or at least overlapping potential market. And so I just wanted to throw out there at the beginning that we are allowing companies to apply to both of them. But if you get approved for both, we're going to make you choose which one is better for your company to use. That does not apply to the multi-fund program, since that's more in the realm of private capital and private decisions being made. So those can overlap. Can I get my slides to move? There we go. Real quick, just about SSBCI in general. Federal funds, like Finn mentioned, they're from the Department of Treasury. It was part of the American Rescue Plan Act. We've got our first tranche of almost $30 million, and we are committed, I want to say, through about 9 million of that so far. There's 6 programs overall. And then one of the really important things that comes into play here, as you might imagine, with federal funding, it's quite there are quite a lot of regulations. And one of the most important factors in the use of any SSBCI dollars is that it's the cause and result of private financing. So really the whole goal of the market is to get private financing into the market. So with that, we have some restrictions that we are following for who the money that you raise under a growth loan fund comes from. And we're actually following the Angel Tax Credit Program regarding principals and whatnot who are contributing, because it's more difficult to assess that that money would not have already gone into the company. There are a couple of my colleagues from DEED who work on in our tax benefit unit, and they might be able to give you some additional information also about what Angel Tax Credit looks like. Quick program overview. So the Growth Loan Fund is a 2.0 version of a program that we ran back when SSBCI first existed in 2010, which was called the Angel Loan Fund, if you're familiar with that. This program's a little bit bigger. Both the loan size and sort of there's some change in terms to just make it work a little bit better. Again, this is very closely tied to Angel Tax Credit. So you'll see our target market is also early stage businesses engaged in technological innovation in the state of Minnesota. And we lay out a number of qualified fields there, which I will not read through, but they are up on our website and on ATC's website. Again, following Angel Tax Credit, we have some limitations on what the primary business activity would be for the companies. Again, I'm not going to read through them all, but they are very focused on sort of that high-tech innovative space in Minnesota. So eligible applicants, basically we're looking at companies. This is under Treasury guidelines considered a hybrid equity program. We are providing loans, but the private capital that's coming into the deals has to be some form of equity. So we are, as part of the application process, evaluating what your targeted equity raise over the next 12-month period is. You have 12 months after enrolling, after your application is approved to be enrolled in the program to raise that capital. I'll go over some of the size restrictions around that in a little bit. Another thing that we are requiring is that you have some demonstration that you are investment ready. So the 3 things that we will consider applicable to that are if you are Angel Tax Credit certified, if you have a letter of interest from a venture capital fund, or if you have a letter of interest from at least one accredited investor. The applications come direct to DEED. They are posted on our website. And one of the things that applies overall to SSBCI, and Finn touched on this a little bit, is that there are certain certifications that for compliance purposes, Treasury requires of all businesses that are funded through any SSBCI program. So those would include that the business is going to use the funds for an eligible purpose, that there are no conflicts of interest, and I'll talk a little bit more about that later. And that no principal of the business has been convicted of a sex offense against a minor. This is just a high-level overview of what our application looks like. It's a lot of the things that you would expect, sort of the business filing details, your business plan and pitch deck, some historical financials. We do require at least 1 year. And projections as well. And then what your fundraising plan is, basically to get you to that equity raise that you've proposed. Some things about commercialization, and what the IP is associated with the business. So once you're enrolled, you have that 12 months to do that raise. You need to raise a minimum of $500,000 because that ties into the program loan minimum, which is $100,000. And if you are targeting over $500,000, you have to meet at least 70% of the proposed raise in order to eventually be able to draw the loan. So at the time, there's sort of a part 2 application that we have where you bring your proof of investment, which is your proof of that you've been successful at your equity raise. We do, again, require that at least one of those equity investments come from a venture capital fund or a unaccredited investor. So you can have crowdfunding and whatnot in the deal and non-accredited investors, but that can't be the sole source of capital or of equity that's coming into the business. So the loan that we issue is going to be for 20% of the amount that we raised. As I mentioned, the minimum is $100,000 and then the maximum is $400,000. If you applied for a lower amount of equity than you actually end up raising, there is an opportunity when you come in for your proof of investment to make a one-time request to amend the loan upward. I should also mention, if you discover shortly after the approval that you think your fundraising goals were not being met, if you come to us quickly enough, we may be able to amend the enrollment amount and the equity target downward. That is going to have some reasoning behind it, but I know that in the current funding environment, that's been a concern for some businesses. Once we review the proof of investment, consider that it is all set, we have a loan agreement that you enter into directly with Deed in order to meet our compliance requirements of Treasury. There is some annual reporting about the business, including revenues, additional funds that you receive after the loan is made, and job creation, that sort of thing. The loans are non-recourse. They're set up for 7 years. Amortization is not really quite the right word there, but they're on a 7-year term. 1% interest. We are not collecting any repayments on principal until year 4. At year 4, we amortize half of the principal of the loan. That gets paid out through the end of the 7-year term. And at the end of the term, there's a balloon payment due for the remaining 50% of the principal and any outstanding interest. As I mentioned before, loans have to be used for an eligible business purpose. It is pretty broad what Treasury considers an eligible business purpose. And as long as you are otherwise within program requirements, the main prohibitions are against purchasing any ownership interests. So you can't buy out any of the partners in the company or any of the prior investors. You can't purchase passive real estate. You can't purchase goodwill. And then there are also some prohibitions against businesses that are involved in financing, basically, which I know may or may not come up since folks in the fintech space might be affected by that one. There is also a thing called an inventive sale agreement that we ask that companies enter into. This is basically Deed's potential upside on this. So we can't make equity investments, but this is tied to the loan and is basically if you sell a certain portion of the company, you have to pay off the loan early plus 10% of the original principal balance. And then we do ask, again, if there are significant changes in ownership, that the loan get repaid at that point too. Just a quick update and maybe a little bit about our process. So unlike the university where they're really looking at the very specifics of the particular proposal, Deed has a standard scoring matrix that we're evaluating all businesses under, and we have a standing internal loan committee that does those scores and reviews. So basically all of the businesses that come to us for this program are being assessed under the same criteria, regardless of industry, use of funds, amount that they're expecting to raise, et cetera. So far, we've enrolled 16 businesses in the program for about $3.2 million. Those are all still contingent upon successful equity raises. The program has not been running all that long, and so we have not had any actual loans go out the door yet, although we do expect that to happen in the next probably couple of weeks here. Funds are still available. The program is still open for enrollment. Everything is up on Deed's website. We are happy to answer any questions about eligibility. I did want to touch on conflict of interest real quick, because the SSBCI in general has very, very strict conflict of interest requirements around any SSBCI insider having a personal financial interest in a potential, in any deal that is run through the equity programs, and there is no way to recuse oneself. And so we have run into some challenges with that, just because this is a very small market. So just wanted to give folks a heads up on that there have been companies that through no fault of their own, we haven't been able to enroll in the program. And I think that's been true for the direct investment program as well. Real quick, the other 3 loan programs that we have here, or loan debt related programs that we have, we're running a loan guarantee program, guaranteeing 80% of loans up to an $800,000 guarantee for banks and enrolled nonprofit and CDFI lenders. That directory for those lenders is on our website. We have a purchase participation program we're running also with CDFI and nonprofit lenders. That directory is up on our website. Those programs you apply directly with the lenders. They have a broad range of use and a much broader industry expectation, and don't require that you're raising equity. And then for folks in the manufacturing sector, which is probably no one on this call, we have a loan program that assists with purchasing automation equipment for folks who are doing some increases to automation and productivity in their manufacturing facilities. That is basically everything I've got here, and I can take questions, and I'm going to stop sharing. Although here, there's one in the chat. I found the chat, guys. If a company already completed its equity raise, you have to be raising all of your capital during that 12-month period. So you have to get enrolled in the program, and then anything that you raise in the next 12 months would count. So we have no look back period. That again goes to the cause and result of private financing. We can't prove that they wouldn't have invested because they already did.
Finn, I see you. I see Finn has a raised hand. Is there something you'd like to add?
Yeah, I just want to add something. You know, on the SSBCI guidelines, how the programs are working and so on. I just want to mention, Joanna, I lost track if you may have mentioned this at all, but you know, we are involved in working groups with other states who are also implementing these typical programs, and some of them are really new, so everyone's kind of learning how it works and how to improve it. So you know, some of the guidelines, some of the limitations Drew mentioned that companies have maybe gotten snagged in. You know, we're working with Treasury to be able to present, you know, here's kind of the reality of how things are working, and in some cases get an exception to be able to make that work. I'll give you a great example. The first investment we made with Brown Venture Group, Drew, I think we had to get an exception on that, right? Because it was a subsequent fund close. So that's an example of how we can work with Treasury and as it relates to some of these guidelines to make sure we can make it a little more friendly to the fund managers, the companies we're working with.
Thanks, Finn. They make non-equity investments. Well, a federal agency investment generally in any of these companies would not qualify as private capital. And so any government investment would not work through launch. For folks who are involved in SBIR, STTR, there is a matching grant available through the Launch Minnesota program. That is the closest thing that I can think of that might address any of that, although Maddie, maybe you've got something else.
Yeah, I'm happy to answer any questions about the SBIR, STTR, and oh, it looks like there's one more. If there was a conflict of interest with the direct investment fund, is that automatically true for the loan program as well?
Yes.
Okay.
And the multi-fund program as well. All three of the equity related programs have the same overlapping group of individuals that qualify as insiders.
Got it. Sounds good. Okay, awesome. Thanks, Drew. Any questions? Any last call for questions from the audience here?
And I did throw our website and our general email in the chat, just
Awesome.
if folks want to grab those.
While we're talking about funding, I should mention that the Launch Minnesota Innovation Grants are still open and will be open until the 31st, so next Thursday. So get those apps in if you would like to apply for innovation grants. And the next chance to apply for innovation grants will be in January after this round. All right, looks like there's a couple more questions, Drew.
Well, I guess just coming back to the DoD thing, yes, I understand that, but either way, it wouldn't count as private funds, so it wouldn't count toward your equity raise. So if you're doing an equity raise and you're getting those DoD funds, that's fine, but the DoD funds are sort of out of scope for our program because they are, because they're public funds. So the program growth loan fund works on a first come first serve basis. So we just take in applications, we review them as they're complete, they go to loan committee, everybody's scored against the same criteria. So it's not, there's no one's competing against each other. You're competing, I guess, against funds running out is pretty much all, which right now is not too big of an issue. And the majority of the applications have been approved on a funding or based on scoring, I would say. I don't know the exact percent. And then we have had some that have fallen into that conflict of interest bucket and not been approved for that reason, but not that either didn't necessarily get to scoring for that reason.
Sounds good. Okay, well, thank you again, Drew and Finn, for taking the time to share info about SSBCI. This is a really awesome program that I hope people take advantage of. If this is your first Friday Forum, thanks for coming. We do these on the fourth Friday of every month, so stay tuned. We got more coming up in September and October. And if you would like to find the recording of this or other Friday Forums, it is available on the page that I just put in the chat. So that is all we got for you. Enjoy the rest of your day, everyone. Have a wonderful weekend, and we will hopefully see you back here next month. Bye, everyone. Thank you.
Thank you.
Thanks, Matt.